If you can master in spot liquidity early, you will be able to enter a trade just before smart money enters into the market, bank consistent profits, and drastically improve your win rate. So what exactly is liquidity? In this video, I will share vital points about liquidity that most YouTubers miss. Most trading gurus draw liquidity all over their charts, use hindsight, and then overcomplicate liquidity. They do not give you a proven, repeatable framework that you need in your trading. Most people draw all of these fancy liquidity schematics, but on their own, they are absolutely useless. Do they make money? Absolutely not. You are spinning your wheels until you have a proven, repeatable process that you can rely on. In this video, we will cover the critical rules that have helped hundreds of my inner circle members get funded and become consistently profitable using the laws of mechanical trading systems. In this video, we will cover my mechanical liquidity trading strategy, what is liquidity, why liquidity is important to institutions, how to mechanically identify liquidity, understand liquidity inducement, mechanical directional bias, intraday liquidity cycles, when to enter the market, and how to enter the market for maximum profit. All right, let's dive in. Liquidity is the lifeblood of the markets. But first, before we dive into the specifics of liquidity, you first need to understand the premise of my mechanical strategy. My entire technical strategy is based around the idea of identifying where big money is entering and exiting the market, and then to trade in line with that. First, I use directional bias and then I trade in line with that. Secondly, I use kill zone liquidity to time and refine the idea. Thirdly, I use intraday liquidity cycles for market context. And finally, I use mechanical entry models to position myself into the market. So I've broken the system down into two simple frameworks, framework 1 and framework 2. So this is a one time frame strategy, meaning that everything is going to be on the 15-minute time frame. So what I'm going to be looking for is a pro-trend 15-minute bullish market. I'm then going to be looking for the engineering of liquidity. This is via the Asia session. Then I look for a inducement into the market. This is below the Asia low. I then use a mechanical entry model to position myself into the market. And then the goal is to take part in the New York distribution. Then we can look at targeting fixed mechanical risk to rewards, external range liquidity, or we have the Asia high. So this is the base case, but I also have another framework. If we identify a pro-trending 15-minute time frame, and let's say that the Asia session distributes in price, then the expectation is that the engineering of liquidity will occur during the London kill zone, and therefore the inducement will take place during the pre-New York session. And then again, the goal is to take part with a entry model that is mechanical and fully defined. Then once we position, we can look at taking part in the New York distribution phase. This is where we can look at targeting mechanical fixed risk to rewards, external range liquidity, and we also have intraday session highs for targets as well. So what is order book liquidity and why is it important? Liquidity is the amount of supply and demand in the market. On the left-hand side of your screen, we have a liquid market. We have price on the left-hand side and we have volume on the right-hand side. Every buy order must have an equal and opposite sell order for a trade to take place. So imagine that you are a large institution or a large entity. Well, you can easily position into a liquid market because there's enough volume, there's enough people on the other side of the trade so that you can fill your orders. But the problem is that large participants, they need equal and opposite amounts of supply and demand in order to exit and enter in order to minimize slippage. So for example, imagine a large institution that is looking at buying $800,000 of this market right here. So what you can see is 50% of the order can be filled at the ask, and you can see there's no volume that's available at these prices right here. And so what's going to happen is 50% is going to be filled here, price is going to start rocketing to the upside, the other 25% is going to be filled here, And then the last of the orders, the last 20% are going to be filled right here. So therefore, a institution or a bigger player that wants to buy at current market price, they're going to get a awful average price. And in doing so, they're going to result in a lot of slippage in the market. So liquidity in trading is the ability to buy and sell an asset quickly without significantly affecting its price. And so what you're going to do when you turn up to the markets is you're going to see levels of liquidity all over the chart. You have different levels of supply and demand everywhere in this market. And this is where traders go wrong because they draw liquidity everywhere. So we need to know which levels of liquidity can the institutions use and which ones are actually significant in the market. But not only that, we need to know which ones are mechanical and how we can define that in an objective framework. And so where are the biggest liquidity pools that institutions can use to trade against retail? And so the first one is highs and lows. So the assumption is that every high in the market has buy-side liquidity that is resting above this high. Next, we have a strong high. So imagine that price pushes to the upside, we get a high in the market, then we get a pullback, we get a higher low, we then get another higher high, and then we break and close below right here. So retail are going to see this as a strong high in the market because they see this as taking out liquidity, and then we're breaking structure to the downside. So we know that this is going to be generating buy-side liquidity above this high right here. And so institutions can use this equal and opposite buy-side liquidity to fill their sell orders in the market without encountering any slippage in the market. Another example is equal highs and lows. So for example, if we have a high in the market followed by a pullback, when you see price coming back to this level, retail are going to see this as a double top in the market. They're going to then short this, and we know that this is generating buy-side liquidity above here because where are they going to place their stop loss, right? Their stop losses are going to be resting above this double top right here. We next have trend line liquidity, but I will say that this is a very subjective way to identify buy-side liquidity in the market. But again, what a trader is going to see this, right? They're going to see a low, lower high, lower low, etc. They're going to draw their trend line on this chart, and they're going to place the stop losses above these highs. So we know that this is an area of interest that institutions can use, that they can drive price to these levels in order to effectively fill their sell orders in the market, because they have the equal and opposite orders so that they can position and then they can take price lower. Vice versa, we have a significant low in the market. We have sell side liquidity generated below here. We have a strong low where we have a low, lower high, lower low. We break structure, but then we shift in market structure right here. We have equal lows, and we also have sell side liquidity in the form of trend line liquidity. So this is all well and good, but this is where most people stop. But the problem with all of these right here is that these liquidity pools are very subjective in the market. And so most traders are going wrong because they're identifying liquidity in a very subjective way. So what I'm about to share with you is 3 mechanical ways to identify liquidity pools in the market. So this is what we call intraday liquidity. So as we know in the framework that we are trading based on the 15-minute time frame. And so we are trading on an intraday basis. So the first way to mechanically identify intraday liquidity that institutions could use to fill their orders is previous day's low. So what you're going to be looking for is for price to trade down. Let's say that you have a long bias on this market. You're looking for price to come down, liquidate below the previous day's low. This, as we know, is going to be providing sell side liquidity behind the low that institutions can use to position themselves into the market. They therefore can prevent slippage in the market. They can fill their orders effectively, and then they can look at targeting higher prices. The next level is the London low. And so let's say that you're trading the New York session. You're going to be looking for the previous session's low, which is the London low. You're going to be looking for price to come down, take out the London sell side liquidity, and this acts the same as the previous day's low. This is an area of interest, and this is a level that institutions can use in order to fill their buy orders without slippage in the market, and then they can look at targeting higher prices. But the most important one is the Asia low, and this acts exactly the same. So what I recommend you to do when you're starting out is just to start with the London low and start with the Asia low. These are two very mechanical ways to identify intraday liquidity in the market. And so examples of this, right? This is a long bias right here, and we're going to get onto directional bias in a moment, but let's just look at this in terms of intraday liquidity. So because we're long bias, we need to see price come down, take out the London session low, take out the Asia session low, and then once this has happened, institutions can use this sell side liquidity to position themselves into the market. They can effectively be positioned into this market, preventing slippage because there's enough people on the other side of the trade in order to fill their buy orders. Then once they're positioned, price trades higher. So this is the New York distribution. So notice as well, Asia distributes in price. Therefore, we can expect London to accumulate, and therefore we can expect New York to come down and liquidate either below London or below Asia. Vice versa, here's the flip side of that. So let's say that you're sell bias on a market, then you're going to be looking at previous day's high, London high, or Asia high. You're going to be looking for price to trade above one of these levels. Once you see that, you know that institutions can be filled here, and you know that there's a lot of generated buy side liquidity above these levels that they can use to fill and then trade this market to the downside. So you always need to ask yourself, who is going to be on the other side of this trade? So if I want to get short, where are the buyers in this market? How are the buyers feeling in this circumstance? An example of this, so this is a sell bias market, and again, we're going to get onto this in a moment in terms of directional bias, but what do you want to see? Well, if we're sell bias on a intraday basis, you want to see price trade above at least the London session high. In this scenario, we trade above Asia as well. This allows and provides the buy side liquidity. Institutions can position, and then they look at trading the market lower. But why do we get these liquidity pools forming? Well, this is due to something called liquidity inducement. And liquidity inducement in trading is a smart money concept where price moves in a deceptive way to trigger buy or sell orders, i.e. liquidity from retail traders, only to then reverse sharply, trapping those traders and allowing big players to fill their own orders at a better price in the market and ultimately prevent slippage in the market. So the first form of inducement is when you see price trade lower, form a low in the market, you form another low, and then when price comes back here, retail are going to be looking at buying double bottom. So what they're going to do, they're going to buy, they're going to place a stop loss below the double bottom, and they're going to be stopped out, right? So they've been induced long into this market. They get stopped out, and so they're providing sell side liquidity into this market. The second form of inducement is selling breakout or momentum traders. So, traders are going to see this as a flag pattern right here. Let's say that you're sell bias on a market, and when price closes or breaks below right here, traders are going to be shorting this breakout. They're going to short this breakout, stop loss right here. And so they're going to be induced short into this market, thinking that the market's going to trade lower. And they are further providing sell side liquidity into the market that institutions can use to position themselves after the liquidation and then look at targeting higher prices. The third way is buying strong lows in the market. So, imagine price trades down, we get a pullback in price, and then we get a clear lower low in the market. So traders are going to see this as a liquidation. And then what do we see? Well, we see price close and break above right here. This is what we call a change of character. And so retail are going to see this as a break in market structure to the upside. And then when we do trade back down to this level, they're going to see this as like a demand zone. So they're going to be looking at buying the pullback with a stop loss below the strong low. And so they're being induced long into this market. They're providing sell side liquidity. They get stopped out, and then price trades in the intended direction. And we have the exact vice versa to this, right? So we have buying double tops in the market. So, let's say that you're sell bias in the market. Well, the second time price trades back up to here, Traders are going to short this double top, stop loss above the double top, providing buy side liquidity because they're going to be getting stopped out and they're going to be induced short into this market. The opposite is buying a breakout or a momentum trade to the upside. So they're going to see this as breakout right here, invalidation below the breakout. They're going to be induced, then they get stopped out and they are further providing buy side liquidity. And then vice versa to a strong low, right? We have a strong high. So we have a high in the market, pullback, break of structure to the upside. They're going to see this as a liquidation. Then we shift and we get a change of character to the downside. They're going to see that as a change of character. And when price pulls back, they're going to short this supply zone. Stop loss above the strong quote unquote high, and then they are providing that buy side liquidity, and then we roll over. And remember, the whole goal here is understanding where retail are going wrong in the market. They are trading retail concepts, and that is why they're being induced into the market. Institutions are using this inducement in order to position themselves into the market because they know that they have someone on the other side of the trade that can provide that liquidity to them. Not just another person, right? But thousands and millions of traders. But inducement means nothing unless you know what your directional bias is for the session. But this is where you're going to have to hear me out. So what I see from my 8 years of trading experience is that traders are using maybe a 4-hour fair value gap, a daily order block, and things that are very subjective in order to identify their directional bias in the market. Even market structure is a very subjective way. Like, how do you define market structure? There's many different rules and there's many different ways, and a lot of them are very subjective. So what I recommend to do when you're starting out in the markets is use a simple 50, 100 and 200 exponential moving average. This indicates to you as a trader that we have a long bias market, and so you would only be looking for long positions, because a huge problem that so many traders are facing is like 1 minute they're long, 1 minute they're short, and they just constantly sort of keep flip-flopping in the market. And then you look back at the end of the day and you're like, what the hell happened? So, you're pissing in the wind unless you actually work out a mechanical way to identify your directional bias in the market. And so this is literally a trade that I took the other week. And we even spoke about this before when we were talking about session-based liquidity sweep. And so this was an example of a buy bias market. We have the London low, we have the Asia low, we liquidated below here. This is a long bias market. We expect higher prices. Then once we've seen that, we can be looking at getting positioned in this market. An example of a sell bias market, we literally looked at this same example before, but now we're adding a directional bias. We're adding a mechanical filter. So what do we have? Well, 50 is less than the 100, which is less than the 200. And so sell bias market. So you're only going to be looking for sell positions. So when you're sell bias in the market, you only need to be paying attention to buy side liquidity. So you're going to be asking yourself, where is the fresh liquidity resting? And as we've discussed, right, the mechanical ways to do that on an intraday basis is previous sessions highs and lows. So this is the London session, Asia session, and the previous day high or low. The third directional bias that is possible is a no bias market regime, meaning that you would not be looking for any positions in this market. You can see right here, we had the 50 EMA, which is crosses over the 100. And as soon as we get that, we have a no bias market. So this would be an example where you're going to be sitting on your hands, you're going to be waiting patiently, and you're not going to be executing in this market. You're then going to be waiting for the EMAs to get back in order. Let's say this is the 50, this is the 100, and this is the 200. Well, you now have a long bias market. And so you can start to think about maybe getting long in this market. So this is where so many traders go wrong. They don't have the discipline. They don't have the accountability to sit on their hands and wait when the market conditions are not correct. But let's be honest, directional bias is useless unless you understand intraday liquidity cycles. So let's first start off with the expectation. So this is the general base case scenario. So as we know, this is a 1 time frame strategy. Everything's going to be on the 15-minute time frame. We now know about directional bias. We know to mechanically identify that. So let's say that this is a 15-minute bullish pro trending market. Well, the base case is that Asia will accumulate in price. So the engineering of liquidity often takes place in Asia, and this is where Asia accumulates, meaning that we are generating, if you're long bias, right, you're generating sell-side liquidity below the Asia session low that institutions can use to position themselves into the market. What you often find is the Asia high would be taken out. Then once we've seen that, the institutions take price lower, because what this is actually going to be doing is inducing traders long to the buy side, seeing this as a breakout to the upside. And so they're going to have stop losses in this move right here. And so they're further providing sell side liquidity into the market. So once we've seen that, then we're looking for that liquidation below the Asia low. This is where the inducement happens, because think about what we spoke about before about liquidity pools and where liquidity is resting. So when price gets down here, traders are going to see this as like a double bottom in the market. Stop loss below the Asia low. Also, if you've got any Asia traders, if they're long in Asia, they're going to have a stop loss below the Asia low. And so they are further providing sell side liquidity that the bigger players can use in order to match up their institutional buy orders with all of this retail sell orders. So once you see the inducement, then it's a case of waiting for your entry model, which we're going to get onto in just a moment. Once we position in here, we're going to have a clear invalidation and then look at taking part in the New York distribution. When you're starting out, I recommend using a fixed mechanical risk to reward. This means targeting like a 1 to 2, maybe even a 1 to 3, rather than using discretion to work out where you're going to be targeting. Other targets are external range liquidity, meaning the range highs, and another target is the Asia high as well. And so we've looked at the base case, and we're looking at how we can use previous and past price data in order to predict future price movements and also future expectations of what you can expect for the upcoming sessions. Where traders go wrong is they're uninformed with the Asia distribution. So again, 15-minute time frame, let's say we have a bullish market regime and we see a pullback, and then Asia distributes in price, which just means that it impulsively moves to the upside. Well, then the expectation is that the engineering of liquidity, right, this sell side liquidity needs to be generated. So if Asia distributes, we can expect London to accumulate, meaning that London goes sideways, and then we can expect the inducement for price to come down to this low. Traders are going to see this as a double or triple bottom in the market. They're going to be seeing this as a support level right here, getting positioned, invalidation below the London low right here. And then once we've seen the inducement, we've seen the liquidation, we know institutional trading activity can occur here. We know that they can get positioned here without affecting market price, without actually having any slippage in the market. And then we use our mechanical entry model, which I'm going to get into in just a moment. And then we look at targeting higher prices. So we can look at literally the Asia session and ask yourself, like, has the Asia session distributed? If the Asia session has, then the expectation is, okay, we expect London to accumulate, because it's very rare that you're going to see a distribution phase and then a distribution phase and then a distribution phase. And so we're going to be looking at getting positioned during the New York kill zone and look at targeting higher prices. But intraday liquidity cycles on its own will not make you consistently profitable. You need to know when to be entering the market. So right here we have the Asia session in red. This is from 6 p.m. until 11 p.m. Eastern. We have the London session in blue. This is between 3 and 5 a.m. And we have the New York session in green. This is between 8 and 10:30 a.m. Eastern. So we are not going to be taking any trades during the Asia session. Our executions are going to come in London between 3 and 5 a.m. And executions are going to come in New York as well between 8 and 10:30 a.m. Eastern. We're not going to be taking any trades outside of these kill zones. And that is because just look at this market visually. During these kill zones, we expect volume to come into the market. So notice here, we get the London open. What do we get? Volume in the market. Right here, we have the New York kill zone. start of the kill zone right here, what do we get? Volume coming into the market. Often what you find is between these kill zones, price often just consolidates. You can see that happening visually right here as well between London and New York. Price often chills out and sort of relaxes. You now know when to enter, but how should you enter the market? I will give you 3 simple mechanical entry models. So entry model number 1 is a retracement candle. Entry model number 2 is a order flow shift. Entry model number 3 is a limit order. Let me break it down. So this right here is an example of entry model 1, which is a retracement candle. And this is where you have a liquidation below a previous session's low, below a objective liquidity level. Then what you're waiting for is bullish pressure to step into this market. You can then enter on the break of this 15-minute bullish candle high, and then you can look at targeting higher prices. So for example, this was a buy bias market. We have the London low right here. This is what takes out the sell side liquidity below the London session low. We know institutions can get positioned below here without any slippage in the market. And so once you see that, you wait for a 15-minute bullish confirm, entry on the break of the high, invalidation below liquidation, and then look at targeting higher prices. So in this example, this was a mechanical 1 to 2 risk to reward. Entry model number 2 is a order flow shift. So this is where you have a low in the market, followed by a pullback, followed by a lower low. So this takes out sell side liquidity, right? And this is if you're buy bias, then you're waiting for a change of character on the 15-minute time frame, then look for a pullback into a level of interest, and then look at targeting higher prices. So if we zoom in right here, buy bias market, we've identified sell side liquidity below London low. What do we see? Liquidation below here. We have a low in the market, followed by a pullback, lower high, followed by a lower low. Therefore, once we've seen that, we're waiting for a break and close above. This indicates a change of character. Then once you've seen that, you're going to look for a pullback into a order block, a fair value gap, or you could even look for a Fibonacci retracement. So if you plot a fib from this low to this high, you can look for price coming back into, 61.8, 72% retracement, get filled, and then look at targeting higher prices. So this is the most conservative entry model, and sometimes you're not going to get that pullback in price, and price is just going to continue without you. The third entry model is a limit order. So again, buy bias market, you're going to look for that liquidation. You're then going to look left and you're going to look for confluences on the left-hand side. You're going to place your limit, stop loss below confluence, and then you're going to be looking at targeting higher prices. So this is the most aggressive way to enter into the market. And as a result, you end up getting better risk to rewards in the market. So, you're taking on more risk, and so you can expect more reward. So this is the exact same trade as before where we're buy bias, we have the London low, we see that sell side liquidity taken out, and so you have a fair value gap to the left hand side right here, which is just a inefficiency in price between this candle high and this third candle high right here. So notice how these don't touch. This is a fair value gap. You also have an order block below here which created this impulsive move to the upside. But this is where some subjectivity can come into this, because do you take this fair value gap? Do you take this order block? Where do you actually place your limit order? And so you're going to place your buy limit, wait for price to come down, tag you in, and then you're going to be looking at targeting internal range liquidity, external range liquidity, or you have session highs here at the London high. Your stop loss would go below the confluence, right below this order block, or maybe below this candle before, in order to be a little bit more conservative. And so notice how everything's sort of starting to tie in together. So right here, notice back to what we talked about, Asia distributed in price. Therefore, we can expect London to accumulate. We can then expect the New York to manipulate below, take out that sell side liquidity. Institutions can get positioned in here effectively without affecting market price. They can get filled, and then we can look at targeting higher. So this is the exact entry schematic right here. Asia distributed, London accumulated, the manipulation occurred during the pre-New York session. We then position via a mechanical entry model, and then we look at targeting higher prices. So notice how everything's starting to piece together here. And so if you would like to learn more and you would like to see me trade this live every single day in the markets, and you would like to learn the exact blueprint to this fully mechanical rules-based trading system that takes all of the guesswork out of your trading, where I hold your hand every step of the way, and you would like to learn a proven profitable system that has got me funded over $1 million in verified prop firm capital, that is proven over years and years of data, and it's backed up by hundreds and hundreds and hundreds of trades, that allows me to make on average $35,350 per month. That has also helped hundreds and hundreds of my inner circle members get funded and become consistently profitable. Then make sure to check out my exclusive community or my one-on-one mentorship. The link is in the description down below. Thank you for your time. Take care. Bye-bye.